Sir Andrew Shook, thank you for joining, my friend. You got 5, 4, 3, 2, 1. Here we go. We're live. We're going live and living color. I say Sir Andrew Shook because I only know you as Shook, Shooky Bear, Mr. Shook, Swordfish. I didn't know that your parents gave you a first name. I thought Shook was it. So
Yeah, well, it was
good
a
to
great debate, to be honest with you, but they ultimately decided on something that started with A. So,
there you go. That's fair. That's fair. It makes sense. I get the full picture now. But thank you for joining. You are again. I know you as our multifamily guru in house. But tell me a little bit about what you do at Lima One Capital and your background in the space. You have been, you've run some shops, so you have quite the pedigree here.
well, that's kind, but I have been at it for more than a minute. There's no doubt. But yeah, my responsibilities at Lima One are to really, look after the capital markets function for multifamily, help with product development and pricing, and it's a bit of a dual role. I work with a lot of the salespeople on structuring transactions and trying to make sure we can get them organized in a way that puts the right risk on the balance sheet and gets the deal done. Interface a lot with our credit partners, and make sure everything is addressed, and and pricing. So um, I mean, it's not literally my title, but almost like a product manager kind of role. But technically, I'm head of commercial real estate capital markets for the firm.
Got it. And I want to dive right into kind of the multifamily and commercial world. I was walking on our sales floor earlier this week, and CNBC was on one of the TVs, and you saw just a bunch of news, inverted yield curve. What in the world does that mean? I mean, what is an inverted yield curve? And why does that matter in the multifamily and commercial space? Does it matter? And if so, why?
Oh, it matters a lot.
Yeah.
Yeah, for sure. So a normally shaped yield curve is a yield curve where the longer maturities have higher yields. So the yield on the 10-year Treasury note is greater than the yield on the 2-year Treasury note. And it's this year in the markets has been so tumultuous. Um, 2 years ago and a half, we had the COVID outbreak and all of the uh, tumultuousness and uncertainty that was created from that. Then everything settled down, and from a financial markets perspective in 2021, and then with all of the stimulus and the printing of money and other factors that were in play, we've had this massive spike in inflation. And as a result, the Fed has had to raise rates significantly. I was just, looking at a couple of quick charts before this episode, and just 12 months ago, the 2-year swap rate was 30 basis points, a third of a percent. And right this minute, it's at 386. So it's more than tenfold higher than it was. And currently, the 10-year swap rate is right at 3.35%. And so when you have this relationship where the 2 years at, call it 385, and the 10-year is at 335, that's an inverted yield curve where the shorter maturity instrument has a higher yield than the longer maturity instrument.
All right, Shook. So to use your words, I'm going to make a gross oversimplification and tell me true or false on my gross oversimplification. So would it be fair
False.
to false there? Probably, but knowing it's a gross oversimplification, let's see. Would it be safe to say, or would you agree with the statement that you have Class A top 20%, Class B middle 60, Class C lower 20? Is it a fair statement that your safest investment on a risk reward calculation is going to be in that middle 60%, the Class B property?
Well, I all kidding aside, I wouldn't. classify it as, safest for lots of reasons.
Mhm.
Um, but I think what I would agree with wholeheartedly is, look, sponsors of the really high end Class A buildings do fabulously well. They can do fabulously well, and they're beautiful properties. But they are, in fact, by definition, um, uh, addressing a relatively small slice of the market,
Sure.
right? Because it's this layered effect of, someone has the ability to pay and they're willing to pay, and what might, you know, we're we're all emotional beasts as human beings, right? So when we signed up for that lease 2 years ago or a year ago or whatever, we might be feeling great for whatever reason. And now, if we have more uncertainty, even though we could pay, we may be like, hey, you know what? I'm going to move into a lower dollar price place because I just, something unsuspected happens. I just feel a little better. But certainly, when you're addressable market, if you will, if your core um, tenant base represents that middle 60%, and of the people that can pay, right, you've just got a lot more people, and most markets are not heavily overbuilt, uh, in Class B apartments, so you don't have this worry that supply is going to outstrip demand and put rent pressure on you from that regard. But you get to address that middle 60% and some piece of that higher end market that people voluntarily or non-voluntarily will shift out of that higher end, highly amenitized Class A property into a Class B property. So you're and the objective, right, is to fix it up, get it 90 for 90, which is 90%, both physically, at least 90% physically and economically occupied for 90 days consecutively. And then now your property stabilized from an agency loan underwriting perspective. And then you can go refinance your bridge line into um, a Fannie Mae or Freddie Mac multifamily loan or bank financing or life company or whatever the case may be.
Got it. Makes sense. Makes sense. So let's keep it moving. Talk to me about cap rates. This is always a fun kind of multifamily topic. So I'm gonna throw this underhanded softball at you and take a swing at that, however which way you would like.
Sure. Well, again, just to sort of level set information for the audience, I know that we have a lot of very sophisticated people that enjoy the real estate of things, and some people that are learning more. So, just to level set, cap rate is sort of functionally the dividend yield, if you will, on the property. So, strictly speaking, it's your net operating income, which is your collected rents, effective gross income, um, minus the total operating expenses of the property. And then so it's that net operating income, NOI, divided by the purchase price of the property. And to put sort of, common sense, range around that, some of the gateway markets, particularly on the west, San Francisco, LA, San Diego, East Coast, Boston and the greater metro New York area, DC, pockets of DC and the surrounding areas have gotten really low, like 3 odd percent. I've seen a couple of two handle cap rates, and that just like blows my
Scary.
whole understanding. But
Yeah.
it's just that's a very technical bid. A lot of money chasing a small number of assets.
Yeah.
Um, but you're unless you're paying cash, and even if you are paying cash for property, you want it. You've got to have risk adjusted return. I mean, we're all, whether we're doing it professionally or personally, we have a responsibility to make good risk based investment decisions. So why would you buy any asset that was yielding less than the 10-year treasury, right? Because you should, it's got operational risk associated with it.
Mhm.
So cap rates are generally looked at versus the 10-year treasury. And, hey, what's my pickup? What is my incremental yield versus the 10-year? And cap rates are frequently, a cap rate over 7% in most markets is considered pretty high. Again, in the major markets, they're frequently in the threes or low fours. And there's, lots of sort of common markets where that cap rate on a stabilized basis will be in that 5 to 7, upper fours, maybe out to 7.25, 7.5 percent range. And so, that makes a lot of sense. You want some buffer over the 10-year. So, now let's think about the last year or so. You bought a property at a 4% cap rate in some market, and now the 2-year treasuries at rather swap rates at 285, and the 10 years at 335. So if you're looking at the 10-year, now you're just 65 basis points of incremental yield premium over just buying a regular way fixed income instrument. So that's not a particularly, I would respectfully submit, that's not a particularly healthy risk position to be put in.
Sure.
The If you're in a 6 cap, you're still at least 150, 200 basis points to the good, and that's in the context of historical ranges. um, 400 basis points of cap rate spread historically would be very wide, and less than 100 basis points is definitely tight.
Got it. That's fair. Um, from an operator standpoint, I think when COVID broke out and through today, it just feels like we've seen a bigger number of SFR investors moving into the multifamily and commercial space. I think at least from the day to day on the sales side at Lima One, kind of see
Mm-hmm.
that. What off the top of your head, some of the key points of advice, tips, watch out for the nuances for someone who is moving from the SFR space into the larger unit multifamily space?
Yeah, well, it makes a lot of sense. Um, in a multifamily property, all of your doors are on the same tax parcel, right? You don't have to drive across town to, um, fix a leaky faucet or do whatever. So, multifamily properties are much more operationally efficient. Um, that said, they are, a little bit of a different animal. So, depending on the magnitude of your SFR, your existing kind of SFR business, I think you would be uh, well advised to spend a good amount of time interviewing property management companies that have expertise in both the local market that you're investing in.
Mhm.
Most lenders, including ourselves, require third-party professional property management if you don't live very close by and um, can demonstrate that that you have the capability to do so. But also the type of properties that you manage or that the property management company manages. So it's a different thing to manage high end, expensive, very customer service driven, Class A property than it is to manage a garden style apartment. It's kind of right down the middle, which is very different than managing Section 42 property or a Section 8 property. Those properties have a lot of regulatory and reporting requirements, and they're all if you have students in your property, all of those things are present unique property management profiles, and you want to make sure that you've got a good property management company that's got a demonstrated track record in both the market and the property type that you're buying.
Got it. That very sage advice. I was at a multifamily conference uh, both at the end of last year and beginning of this year, and property management was a massive topic. It's an area that if you don't do your due diligence, if you're not thoughtful about it, it will just be a nightmare for your entire life. So good.
Yeah, it's a problem. And then, with no disrespect to the property management companies of the world, but just because you hired a property management company doesn't mean you can set it and forget it. I mean, you have to manage them the way you would manage your own property. So, as they're submitting, repair bills or whatever, make sure they make sense, double check them, and really stay on top of it. So, and then, if you grow more and you want to set up your own property management company, then depending on your business plan and how densely populated your properties are, maybe you can do that. But property management is really key for the long term holder.
Yeah. Great point. Shook, you're in this special bucket of people to me, and I truly mean this. Like I know every time I have any lengthy interaction with you, I'm going to learn something, and that is very exciting and valuable to me, personally and professionally. And so I truly thank you for hopping on this episode, but just more broadly, thank you for being you, my man. I appreciate you.
Well, that's very kind. I love working at Lima One, and it's a great team, and we've had a lot of success. We've been blessed. We're up, over 20% quarter over quarter in the multifamily business alone. Um, we've got, really compelling, T12 origination numbers. So I appreciate you having me on, and look forward to doing some more of these with you.
Absolutely. We'll have you back on sooner than later. For Lima One, visit limaone.com, Limaone. You'll find our great multifamily product offerings there on the loan program page, in addition to SFR, rehab, rental, new construction, bridge. We do pretty much everything here, big tent. So thank you again, Shook. Thanks everybody for listening.